I've been doing online trading and educating for about 20 years now. I started out as a swing trader, kind of just at the very beginning of when online trading was starting to take off. There wasn't a lot of education back then, so I found myself having to do a lot of self-teaching, which was pretty fun for me because I came from a background in arts and science. And I love doing research. So I was working in archaeology for years and doing research there. So it made a really easy transition getting into the markets and looking at pattern and price development in the markets. And I really became hooked very quickly on. So I ended up going from swing trading into day trading, doing futures, Forex, basically you name it, and I've traded it. What you are going to find about the class today is that a lot of the tools and techniques that I use work really well in a lot of different markets. So whether you're a swing trader or a futures trader, you trade stocks, bonds, a lot of my concepts are going to work among all of these different markets. So it's really, something that I love to teach traders, not just newer traders, but traders that have been trading for years, because you can always learn something new. And even today, I've been doing this for about 20 years now, and even today I'm still learning. So I think a great benefit for a lot of these classes like Investor Inspirations is offering is that it gives you the opportunity to just pick up some more tools to add to your box so that you can get to those higher levels in your own trading. And today, the topic that I'm going to talk about is mastering momentum gaps for multi-day trend potential. So a few years ago, I created a course called Mastering Momentum Gaps, and it goes into a lot of detail into how to trade these gaps and how to look for not only entries, but exits, managing it as the trade is unfolding. And in today's class, I'm going to go over some of the beginning aspects of that, as well as looking at some basics with trade management and follow through. So even if you're a more advanced trader, you're still going to get something out of this class. All of the charts that I'm using are from TradeStation. I've been with TradeStation now for about 7 years or so. So let's get started. We're going to start with some really basic information here. There's 4 major types of gaps. And when we're looking at the gaps that are ideal for trading for multi-day trends, there's really a very limited supply of what those types of gaps look like. So in order to look for those gaps, we need to first examine, well, what are the different types of gaps that are out there? We have some very basic ones with the common gaps, breakaway gaps, runway gaps, and exhaustion gaps. So when we look at what these each look like, we'll start with first common gaps. Common gaps are basically the type of gaps that you see from one day to the next. When there's not really a lot going on, market tends to get choppy, there will be a lot of back and forth action, and these tend to be some minor gaps, and they don't necessarily have the best potential for the multi-day moves. So you'll see in here, we have some gaps from the close here, opening up here, and it doesn't really go anywhere. So when you're in the trading range like this, the gaps aren't quite as interesting for multi-day runs. They can be useful when you're looking at some scalping opportunities, but not for longer term holds. The ones that we really want to look at are called breakaway gaps. So here is one example of a breakaway gap. Basically, a breakaway gap is a gap that is coming out of some pattern that is forming in a particular direction. So in this case, we have a really simple downtrend, about as basic as you can get. And as you can see with the trend line here, the gap itself breaks away from that trend channel. So this is a very simplistic view of what a breakaway gap looks like. Then we get into runaway gaps. And a runaway gap is a gap that is continuing the move brought about by the breakaway gap. And we're going to look at some recent examples of this, as well as some examples that have happened over the years. One of the key things that I like to do with every class that I teach is to show how the concepts that we're looking at today and what is happening now in the market, using my strategies, it is exactly the same as it was a dozen years ago. Not much has changed as far as technical analysis goes. So you can use these techniques well into the future. I had a little bit of a break here over the last couple of years where 3 years ago I had a cerebrospinal fluid leak. I had to take a break from the markets for a little bit to recover. Came back, everything that I knew, perfectly the same as it was back then. So it was really just like jumping back on a bike. And I know a lot of you have to take breaks from trading, whether it has to do with moving cross country or you're just, going through some personal things, somebody gets sick in the family, and you have to step away. Maybe it's just that you didn't have a large enough account to really do everything that you wanted to do. So with my techniques and with my type of market development, you're going to be able to do that. You're going to have that opportunity to trade when you need to and when you want to. So with these runaway gaps here, getting back to the gaps themselves, the runaway gaps are usually taking place within the second to third day following a breakaway gap. Now, the best day for a runaway gap is going to be on the second day. It'll offer that continuation from the first day's momentum. Usually there's going to be some intraday consolidation or some chance during the day that the market took to take a break before it offers that continuation. But the runaway gap gives that continuation for our momentum play. Now, the third type of gap here is the exhaustion gap. After about 3 days of upside, the market tends to get a little bit exhausted. It needs to take a break, it needs to rest, catch its breath. Oftentimes, an exhaustion gap can be the end of that trend. You can then see a larger reversal, or you could see a shift in the momentum, such as a slowdown in the uptrend where you would see it move more gradually higher, where there would be a lot more day-to-day back and forth type of action, whiplash type of action. So if you're holding it as a swing trade, which would be a multi-day trade for about 3 to 7 days on average, if you're holding it for a swing trade, after an exhaustion gap happens, you're usually going to be dealing with a lot more back and forth. So basically, kind of the meat of the play is already there, and it's going to be a little bit more difficult to pull more out of it. It is possible, however, to do so, and we're going to look at some of the ways to do that here in just a couple of minutes. First, we're going to take a closer look at breakaway gaps and look at some examples. When you're looking for breakaway gaps, there's some ideal traits that you want to look for. So when you're scanning in the morning, looking at things that are gapping, or the night before, maybe looking at news events that have the potential for a gap the next day, these are traits that you want to watch for. The first one is that you want a gap that is less than 1/3 the size of an average impulse move. We will look here at what impulse moves are in just a minute. I want to give you a chance to write down these different traits here before we move forward. The second one that you need to look for is for a bullish breakout. You want a prior day's close that follows an intraday downtrend or a period of congestion. So if we look at this over here, you'll notice that before this gap occurred in February, it had a gradual downtrend and it closed near the lows of the day. What this creates is a very special type of gap called a trap gap. This happens when these bears end up trapped in the wrong direction, so it increases the excitement the next day. So you end up having these stronger, larger moves the next morning where you'll have the best opportunity for getting a strong continuation of the trend intraday and as well as a larger trend on the daily time frame. Now, the third thing that you want to look for is volume that declines leading into the gap. For example, here, again, you could see 3 days of a very steady decline as it was coming down heading into that gap. And it was only with the gap that the volume again rose. Going back to looking at gap size, the first thing that we wanted to look at was how does that gap compare looking at previous impulse moves in that security. In this case, we're looking at AMAT. So in here, we have these prior moves where we have very steady uptrends. And each of these uptrends is what is called an impulse move. You'll hear a lot about things like measured moves or equal moves or using Fibonacci tools like the Fibonacci expansion lines to help identify your measured moves in a particular security. And these measured moves are based upon these impulse moves where you're looking at how far did a previous run take in both terms of price as well as time. Now, when you have a gap, such as here, where the gap is relatively minor compared to these previous impulse moves, ideally being in that lower third of that range, that's when you have the best opportunity for stronger upside, where you have that multi-day trend potential without as much risk that the gap itself will be an exhaustion move. If this had gapped, for example, up here, all the way up into the 41 level, it would have had a harder time following through unless we dropped back and looked at, say, a weekly or a monthly time frame, and there was a larger impulse move on the weekly or monthly time frame that gave it that added move that it could have. Overall, though, I tend to shy away from things that have those larger moves, again, unless it has a weekly chart that is actually going for it as well. Here's another example where we have the different impulse moves and showing what those impulse moves look like. Now, this is a Amerisource Virgin here. This is a recent one. This gap just happened last week where we had a series of impulse moves back and forth. And you'll notice that this gap was on that more extreme end of where an impulse move is. So when we look at A, for example, this one was at that extreme level where the gap was just too much for it. It didn't really have the opportunity to keep going because the size of the gap was too large. When we look over here at B, however, this is a bit of a smaller gap. It had some downside heading into the gap, which is ideal. It's a breakaway gap where it was breaking out of this pullback, so hence out of this correction period. And it had more room based upon looking at the previous impulse moves to give it more upside as a bit of more of a guarantee than if it had already had that larger extreme gap like an A. Now, it did have a couple of cons. For example, the day before it was already closing at the highs, so it's not really a trap gap. But compared to the impulse move going into it, there was still room for upside. The fact that we did not have that trap though, it made it a little bit more difficult to get going. So intraday, when we're looking at gaps, intraday action is incredibly important. So not only are you looking at what's happening on the daily time frames, but I dropped down and I used my intraday charts for timing these gaps. And I'll show you a bit of what I mean by that here in just a couple of minutes. So following this, again, we have C. This is our most recent gap. This is the one that I was trading last week. And I'd actually gotten into this before the gap itself, when we had this little two-wave correction here. And the gap created a bit more of an exhaustion type move because we already had some movement on the downside prior to the gap. So it made some intraday opportunities and continuation, again, a bit more choppy. This did end up continuing a little bit farther here this week. I had taken the chart for this a couple days ago when I prepared these slides, but at the end of class here, I'll go back and show you some of that and what that looked like here on the follow through. So there are some exceptions to the size of gaps. For example, when we have a gap that is a trap, it can offer greater opportunity. But again, when we have a gap that the impulse move is still very small, where we are just getting started on an impulse move, that also gives it greater opportunity. So usually with a gap, I look for gaps that have a range of less than 2 times an average day's range. So if an average day's range is 50 cents, for example, then I usually avoid a gap that is gapping $1 or more. There are going to be exceptions though here, like we see with ACN, where it closed at the highs with momentum going into that high, but overall it had a momentum shift going into that high. So this created this perfect trap gap, which allowed for great continuation opportunity. Whereas over here, we had a gap that was more than twice an average day's range, and it was also approximately the same range as these previous upside impulse moves. So again, it limited the opportunity for really strong follow through coming out of that gap, even though it kept going and we still saw the trend continue. It had a lot more overlap, one bar to the next, as it continued lower. So with this one, with the trap, we didn't run into that same situation. It was coming off of the highs, smaller gap than previously, and it created more of that trap, whereas this one already had some weakness going into it as well. Here is just another chart showing you the same thing, and it's basically showing you where these traps are taking place in the larger trend, where those gaps are occurring. So up here, this was our first one in A, and you can see that by the time the gap happened here, it was already mid-channel in this sort of momentum shift that was taking place on the weekly time frame. On the second gap though, on B, it was coming off of the highs of that trading channel. So it had a lot more room to go before it would hit the lower end of that parallel trading channel. So looking at multiple time frames can really give you an added edge as well when you're looking at which gaps are going to be the most favorable for me. Here's another recent example. So this is CAI, again here in the last week or so. And this is one of those kind of trades that we all dream of finding. I do a lot of scanning looking for these types of trading channels to take place, to find these type of breakaway strategies. And I'll trade these usually even if there's not even a gap with them. But the fact that it had a gap here, that's just an extra bonus. Now, you will see, however, that this one had some upside a couple of days prior to the actual gap. Usually when I'm trading these channels and these trading ranges, I'm looking to get in these channel breaks on the smaller time frames, but a lot of times I might not even find the trade until the gap happens because it won't have come up on any of my scans. So when the gap happens, I would look to then monitor it for intraday activity to get into the position. This is a great example because here's our previous impulse move. As you can see, the gap itself is about an average day's range, and there's plenty of upside before it would hit that impulse move level. Here's another example, very, very similar. This is ATHN. I put this in here because I wanted to show you how these look over time. You'll notice that the date on this is exactly 3 years ago. Same strategy as in CAI, but it took place 3 years ago. Here's the impulse move, trading channel, a little bit of a slower correction heading into that gap, and then our breakaway gap. So these types of gaps really do occur from 1 year to the next. So even if you have to step away, take a break from trading, come back, if you're on vacation or something, these are something that's always going to be there waiting for you. Here's another example again, AMAT, and this time what we are looking at is volume. Volume heading into a gap is another important trait to watch out for. Ideally, you want to see the volume dropping off before that gap happens, because that's going to mean that as a correction was taking place within the channel, whether it's a downtrend or an uptrend or a trading range, if the volume is dropping off, then it's showing that people are kind of moving to the sidelines. There's not a lot of panic or worry in the action. And when a gap occurs, you can usually get stronger momentum with that gap once it hits. So with AMAT here, another breakaway gap. We had the slower move on the downside within this larger trading channel. This is a 40-period moving average here. And then the breakaway gap itself. MVIS, another one from this last week, same type of idea. And here's the volume on these, A and B. Slower momentum, again, this is a 40-period moving average. And they're coming out of these trading channels. So we have breakaway gaps in both of these cases. Going back to look at the past, I want to show you another example going back from 2014 and its relevance to what is happening today. So this is FXEN, FX Energy, which of course was acquired a little bit of controversy over that acquisition about a year and a half ago. But before that happened, this was a subject of some movement based upon some speculation regarding potential buyouts back in 2014. This was in a trading range, in a trading channel. Very nice, solid trading channel here. Volume dropping off, going into the breakaway gap. Weakness ahead of the breakaway gap. And the breakaway gap itself brought in some additional volume once it finally happened. The gap size was modest. If we look at some of these previous impulse moves, you could see that there would have been plenty of room for it to go. Now in this case, we had the added benefit of news propelling the move as well. So we saw even stronger movement than usual. But what I want to look at here in particular is the intraday action. Now, finding the gaps on the dailies is great, it's fine, but what do you do once you actually have it? How do you weed through these, look for intraday action, know how far these are going to move? Well, with FXEN here, one of the things that I like to watch for the initial swing trade action is most of these will have sort of 3 waves of upside coming out of the gap. There will be the initial impulse move, which is marked here with 1. And that is often the most extreme move. That usually happens the morning of the gap. Sometimes it can be an entire trading range to the upside that day. And then it'll be followed by second and third waves. Now the second and third waves can get a little bit trickier because they can be slower. And that's what we're going to see with the action that took place in this last week, because these moves this week weren't driven by announcements like we saw on FXEN. So they were a little bit more in tune with typical type of price action. One of them we're going to see though is going to be Apple from a couple of months ago. I want to show you how that one followed through. This is a trade that I gave back coming out of earnings. Basically, we had a breakaway gap coming out of earnings, had the initial impulse, but because of this being an earnings type of move, the action was primarily overnight to kick off. So the first initial move with Apple took place overnight, and it gave that continuation early in the morning, but then it gave a correction intraday. So when I'm looking to enter into these positions, what I'm watching is the first couple of minutes of the day. A lot of people will have a rule that says, well, I don't trade in the first 30 minutes of the day. This is not a rule that I adhere to at all when I am trading opening gaps, because the best time to get into those opening gaps sometimes is within the first 5 minutes of the day. And if you're using 1 to 2 minute charts, the first 5 minutes of the day can be really tricky to read intraday price action. So it's useful to often drop down and use tick charts for that time of the day. Your patterns are going to be the same. It's just going to show them a lot more clearly than you would on a time frame chart like a minute chart or a 5-minute chart. Now, I mentioned at the beginning that I have a course that is Mastering Momentum Gaps. And that course is 4 hours long with another 3 hours of follow-up, Q&A, some live follow-up that was recorded, and it goes into the intraday strategies that I use for getting into these gaps, as well as greater detail in terms of looking at the gaps themselves. So we don't have a lot of time to go into that today. Like I said, it's 7 hours of material there, but I will give you an opportunity to take a greater look at that course here when we wrap up at the end of today's class. Now, one of the things that we do look at again is how this trend development comes into play. So when I'm looking to trade just impulse type of action, I want to look at usually those first couple of days. And this is because those days are the days that it is the smoothest. You'll get the strongest follow through with the least amount of back and forth whiplash that it can occur once it gets a little bit more extended. So those first 3 waves are key if you want to stay on the lower side of risk management. With Apple, you can see that this had that first solid move onto the upside with the initial 3 waves of upside heading into 135. So when I gave this gap back in here, I gave 135 as a target zone, because what usually happens is that following a really, really extreme gap, you can often get that initial pause and then slower upside that continues, but it's just kind of a slower back and forth type of trend. And what you'll notice here is that it hit that 135 level, and that served as that trigger point to create this greater expansion on the trend channel at that point. It wasn't the end of the trend. It still had more upside to it, but it makes it a little bit more difficult for people where they're trying to go and manage their positions intraday. So when I'm training traders, what we often look at is what their personalities are like, and whether they've been struggling, and if they need things that are just going to help them boost their confidence, a series of wins to help boost their confidence. These are the types of strategies that we focus upon because they have the strongest potential for strong momentum for several days without as much whiplash that can shake out people that are just a little more anxious about their trade, that need maybe a little bit more hand-holding to gain confidence. And then after they hit like these levels such as 135, where kind of the best move is already in, then I work with them to focus upon how to manage a position to get more out of it. And that's where, again, it goes back to looking at some larger time frames and looking at strategies for managing positions and understanding reversal patterns and how to spot them before they've actually developed. And so the Mastering Momentum course goes into that. It goes into it a lot of detail. And as we head up into next month here, I'm going to be doing some live training sessions on Fridays for 4 weeks that's just going to be focusing upon mastering these momentum gaps as well. If we look at another example here, this is CAI. This goes back to the one that we saw happening this week. And this shows you how some of the intraday action can give you a clearer setup. So we had an open that went pretty fast coming out of that trading channel. It would have been really difficult to get into this, again, right at the open, unless you already had this on your radar right away. Again, scanning programs like pre-market gaps, that can help you identify that. And then you can go and use those tick charts to watch for patterns in those first initial moments. There's a lot of things you really have to know in those first moments, though, to get in where you're not going to risk some adverse action, because those first moments go very, very quickly. So the class goes into detail, and the live training session is going to go into detail on how to look at those opening warning moves to try to get into these as quickly as possible. But if you're not as confident trying to trade them yet, what you can do is play around with them a little bit with some small shares, but then watch for intraday strategies to offer continuation moves. One great continuation strategy, for example, is to look for two-wave pullbacks or two-wave corrections. So like here, we had a pullback and then a second pullback that goes into about 11 o'clock. And this continued with a momentum shift again into noon. So it gave two opportunities to get into this midday, whether you missed it in the morning or you just wanted something that could be a little bit slower, that you could follow it, look at it a little bit better. This gave another opportunity. So with these momentum gaps, oftentimes what I'm doing is I'm building into positions and I'm scaling out of them. So I might have a couple of different entries where I'm shifting my stops based upon how the position is unfolding. Again, this is something that when we look at trade management becomes very important. So here are a couple of that were happening that day. And then here's how this ended up following through over the next couple of days, where again, we go and look at FX energy. And you can see, again, these three waves of intraday action. This time, I'm just have a 20-minute chart up here for you. I think the last one might have been a 60-minute, I don't recall. But same type of thing happening, where we have the three waves of upside, 1, 2, 3. And then it becomes a little bit more risky. Things open up, things start to shift back and forth. And actually, I was looking at this again today, this morning, and we had some weakness coming in. So it still might have some more upside on the daily time frame, but the intraday one shows us that things are going to get a little bit more hectic. And when we look at the daily time frame, you'll notice that this was coming into that equal impulse move when we got to this level here above this 2177 zone. So it was already hitting that impulse move zone. So that also created that greater potential that we would start to see things go back and forth. Now again, doesn't necessarily mean that the uptrend is done. You could see momentum shifting where it keeps moving higher, just like over here. Here's the impulse move on the downside, kept moving lower, but the momentum shifted. That same type of thing can happen here now, but that initial impulse move is now done. So when we look at scanning tips, actually, I'm going to back up here. I'm going to pull up some of these live charts here and just show you what they look like right now. So here's that CAI, and you can see here with the momentum shift, here's the initial first wave up, second wave up, and then third wave up. So today, we got that first move on the pullback here. A quick question. I have somebody that mentioned that they don't have sound anymore. Can everybody else still hear me okay? Okay, great, wonderful. All right, let's keep going then. So another one that we were just looking at was ABC. This is a trade again from last week. And here, again, it hit that equal impulse move and it slowed the momentum. So once it got to that level, again, this is something we can use these Fibonacci expansion tools here, kind of show you what happened. So once it got to that 100% level where it was an equal or measured move, we saw the momentum shifting where it goes back and forth, a lot of overlap from one bar to the next. It was able to still keep going because the gap created stronger momentum, but it just created a little bit of a more difficult environment for people looking for continuations. AMAT, Applied Materials, had the same situation going on. If we just look at the momentum part of this previous impulse move here, here's the 100% level. It made it up a little bit farther, but you can see now that the momentum is starting to shift. It had some initial stronger moves, but once it hit that impulse move where it was similar to these previous upside moves, particularly this one down here, which was a really clear-cut impulse move back in November of last year, that we hit that equal impulse move zone. So it made it a lot more difficult for the intraday continuation. You look intraday, we had some first, second, third wave on the upside, managed a fourth little blurb, and then that was basically it. And we saw that fourth little thing going on in a lot of these. So CAI, 1, 2, 3, and then it tries it for a fourth one very, very shortly. And that's often a trap type of thing that's happening. And you'll see that over and over again with these momentum gaps. MVIS here, another one that we were looking at. Again, first wave, second wave, third wave, tries to go for the fourth, and that ended up being it. In this case, it actually ended up being the finish of it. Now going back to the PowerPoint, I want to show you guys here. Let me grab my PowerPoint, which is hiding. Okay, some scanning tips. Look for news and earnings reports, pre-market gainers and losers, and use your scanning platform. A lot of scanning platforms will have things like approaching 52-week highs, or you can program them to watch for specific types of gaps. So get to know your scanning platforms. A lot of platforms you can purchase scans that are built in, or you can create your own. We only have a couple of minutes left here, so I want to share with you a little bit more about this Mastering Momentum Gaps course here. Getting a little tongue-tied, but basically this is a 4-hour class that is one of, I would say it's one of my best-selling classes, the best-selling courses that I've had. People really love it, again, because it's one of those things where if they just want to trade in the morning, you can come in and trade in the morning. If you want to swing trade, you can trade, for several days. If you just want a day trade, it gives you the stocks that are going to be the strongest, have the strongest momentum for several days. So it's really one of my favorite courses. And I go into detail not only how to look for these particular types of gaps, but the most important part is how to trade them, how to manage them. So how to enter them, get into them, place your stops correctly, adjust your stops as it is moving so that you don't get flushed out, and then how to manage your exits as things begin to shift, and even how to look for things as they're shifting to know that you need to be more aggressive with managing your exits, or if you need to be more lenient with managing your exit. For you guys only, this is something that I've never done before when I've done these presentations, but I'm adding also 4 live gap mentoring sessions. This is because when you purchase the course, I want you to not only be able to go through it and learn from the course itself, but I want you to have the opportunity to ask me questions and to engage and to look at things that are happening in the market live that week to show you how to apply these to what's happening in the current market, as well as looking and going back and what we saw happening in the previous market when the course was created. So everything here is available for you guys today for $147. Now the course alone by itself is $359 normally, and the mentoring sessions are usually $200. It's basically going to be kind of like a private mentoring for you guys, for the ones that purchase this course today, because you will have my full undivided attention for 4 hours as we have sessions going over the activity every single week. And this is going to involve looking at the intraday strategies for getting into these momentum gaps. It's going to be looking at the exit strategies for managing these gaps. We're going to be looking at exceptions to the rules, such as when can a gap be larger than is shown here in today's presentation and still work out really well. Now, we are only offering this for 24 hours. Because we need to do the live mentoring session with it. So it is going to be available until about noon tomorrow. I think my guy Vic has it set for 1 o'clock, but make sure that if you want to participate in this live mentoring sessions, as well as the Mastering Momentum Gaps course, which has 4 hours of training in it, as well as an additional 3 hours of information, basically in the form of question and answer, you have to take advantage of this within the next 24 hours. So we're not going to be doing exceptions. I know in the past I've been a little bit lenient on people that couldn't make it, in that time. But because it's so time sensitive here this week, we are going to cap it off at noon tomorrow, or 1 o'clock tomorrow rather. And that's going to be Eastern. So hopefully everybody that gets the recording here has a chance to take a look at this. The sooner you sign up, the easier it's going to be without having the possibility of missing out. If anybody has any questions at all, you can reach me at Toni at tradingfrommainstreet.com. So I will throw that up in here in the chat box. It's Toni at tradingfrommmainstreet.com. That is my email address, my direct email address. So you will go straight to me. You will not go to my admin or my customer support team. You're going to be going straight to me with that email address. So if you have any questions regarding today's presentation, regarding the Mastering Momentum Gaps course, or the live mentoring sessions, just give me a shout out at that email address and I'm happy to help you out.